We're back. It's time for Ask Annex. Got a question for us? You head to our website, annexwealth.com. Look for the Ask tab. In the studio, Ken Bellinger, senior trader. Welcome.
Hi, Danny.
And we got Fred Coleman, a CFP and a wealth manager at Annex Wealth Management. Welcome back.
Thank you, Danny.
First question on Ask Annex. I'm quite confident with the 5% plus for my current cash account. Doesn't look like rates are changing anytime soon. So is there any pressure to consider a next move?
Well, here's the thing about interest rates, especially when you're in a cash account. Once interest rates begin to drop, it'll be almost overnight where that yield on that cash drops. So now is the opportunity because the Fed has started to telegraph its moves. Now is the opportunity to start locking in some of those higher rates. That could be a CD if you're looking for just to get that 1 or 2 years, or if you want to extend it even further and lock it up for the long term, you can look at some high-grade corporate bonds because once interest rates drop, those opportunities likely won't be around for the long term, and you'll need to probably take on some additional risk if you're looking to get that, lock in that 5%.
Yeah, absolutely right, Fred. And I think, again, the core of this goes back to kind of what's the purpose of this cash? You know, if you've got a short-term expense coming up, say less than a year, money market's great, right? But if you've got, maybe it's a longer-term savings account or it's just part of your broader financial plan for the long term, now's a great time to think about moving away from that money market and, towards the long arc, whether that be moving to bonds or into the equity market.
But it's not going to go from 5 to 1%.
No, it'll be a gradual drop, right? But the thing is, with cash accounts, we don't know how fast it's going to go down, right? We can predict, but we know it's going to go down.
Takes a long time to go up.
Oh, yeah.
Doesn't take much time to go down.
Absolutely.
Right. Okay. It's Ask Annex. Next question, and this is a big one. Currently feeling overexposed with, and he names the stock, but it's a big one. Considering options to liquidate 60% of my position, which is $150,000, and diversify, but cautious due to tax implications. Currently maxing the Roth yearly, also contributing 15% to a 401k with a 6% match. Unsure the best strategy to move money to a, quote, safer position, liquidate in one fell swoop and eat the taxes, or cash out in lumps over the next several years to hit the max for a 401k. Any advice is welcome.
A lot of this kind of goes to a combination of tax planning and how concentrated is this position, which is information we don't have. But it sounds like from a saving perspective, we're maxing out the 401k, we're maxing out the Roth. So in terms of the concentration level, every year that thing's just going to get less and less concentrated as you're naturally investing in other assets. That said, if we're nervous about it, or it's just a significant portion of your overall assets, then I think it's time to kind of come up and make a plan with how to get out of there. And Fred, maybe you want to talk about the tax implications a little bit.
Yeah, absolutely. And I think what you were saying, Ken, is how important is this lump sum to your financial plan? There's really a very thin line between looking to minimize taxes and protect your gains. Where does this position fit into the long-term financial plan? So there are some things you can do to protect the position if you don't want to sell and realize those gains right away. You can use options as insurance. So I think of when you have a large position, buying a put option. So that gives you the right to sell that position. No matter if it goes up, goes down, you have that locked in as insurance. The second is important, and it's tax strategy, right? So we don't want to just liquidate in one fell swoop. Not all the time, at least, because all those gains will be in 1 year. So, thinking about the strategy, you had some tax losses from previous years that you're able to carry forward to potentially offset those gains. Or the other option is just spreading those gains across many different years when the opportunity comes. But I think that you're doing a great job with the 401k. But don't forget that brokerage bucket is very important because it's going to give you some more flexibility and tax diversification.
Yeah, absolutely. And, I think another thing to consider here is, if these are short-term or long-term capital gains as well, right? So, if these are long-term capital gains, I mean, we've held this asset for more than a calendar year. Those are going to be taxed at the 15 to 20% range, depending on your overall income. And if it's short-term gains, it just goes straight to your income as if, it's just a check from your employer or what have you. So I think that's another important piece to consider is that, even if you're in a, 30-something% tax bracket, if these are long-term gains, you're looking at, probably 15 to 20, which matters as well. And the other thing you can consider is doing some tax loss harvesting. It sounds like we're investing in individual equities. We all like to think that, we bat 1,000 and Babe Ruth has nothing on us, but you're going to have some positions that are at losses. And those are opportunity to kind of marry harvesting that loss along with some of the gain in this concentrated position to gracefully exit.
You see the way he kind of snuck baseball in? You worked in baseball, didn't you?
I did.
You
I
did.
did. Not on the field.
Yeah.
I thought you were a tennis guy.
Well, now I am, yeah.
That's the way he gets injured.
That's right.
Not the way he gets paid. Ken Bellinger, Senior Trader, thank you.
Thank you.
And Fred Coleman, CFP and a Wealth Manager at Annex Wealth Management, thank you.
Thanks, Danny.